Hello everybody, I'm Aoife O'Sullivan. I'm Causeway's Events and Membership Engagement Manager, and it's a pleasure to welcome you all here today for a topical Causeway event with our corporate members, RSM UK and RSM in Ireland, to give perspectives from both sides of the Irish Sea on how your business can prepare for Brexit. It's really great to see so many delegates here today from across Ireland, Northern Ireland and Scotland, and our speakers today are coming from RSM offices in Glasgow, Edinburgh, Dublin, and even as far away as Tipperary. For those who aren't aware of what Causeway Ireland-Scotland Business Exchange is about, I'll give you a very quick summary. So Causeway is a business networking organisation that has a key role to protect and enhance the trading relationships across Ireland and Scotland, no matter what the political or economic landscape is. It's all about providing an informal business platform that allows businesses to connect, communicate and collaborate. Our events attract our members from across Scotland, Ireland and Northern Ireland, as well as our dual members from the British and Irish Trading Alliance, with whom we have a partnership. And we're also a very inclusive organisation. We welcome non-members to our events who are curious to find out what Causeway is all about. You're very welcome here today. I know there's quite a few non-members here. So Causeway itself, it launched at Edinburgh Castle in 2016, so we're quite a new organisation. We've been growing for 4 years, and over that time, what has been key to our success is really the people. It's the people that make business easy. Causeway is all about growing opportunities and connecting businesses and professionals from a wide variety of sectors. And I'd encourage you to spread the word about Causeway if you think it's of interest for you, your business, or perhaps you know a colleague or friend who is interested in trading across the Irish Sea. Then this is the network for you. Our key host of today's event is Patrick Norris, who has been a loyal Causeway member from the beginning, and he helped Causeway make our launch in Glasgow back in 2017. Patrick is a partner in RSM's Glasgow office, and he has extensive experience of dealing with international issues and heads up the UK firm's Irish desk with specialisms in helping UK companies establish a presence in Ireland. I will now pass you over to today's host, Patrick Norris. Thanks.
Thank you very much, Aoife, and thank you, Causeway. And thank you to everybody who publicised this event. We've had some great exposure, both for RSM and for Causeway, and indeed some interesting contributions from various people. Welcome, ladies and gentlemen, to the RSM and Causeway Brexit webinar. We hope today to tell you about what we believe to be the real and practical issues facing businesses. The road to Brexit has been a bumpy one. So too has the preparation for this webinar. These slides were effectively done and dusted about 2 weeks ago after the Irish budget. But the finance bill enacted in Ireland on the 22nd of October, in fact, changed some of the things that had been forewarned in the budget, and therefore caused us to change some of our presentation. We were ready to go again until yesterday, Monday, when there were some amendments to the Northern Ireland Protocol. And I mentioned earlier about the excellent publicity we've had in the run-up to this presentation. However, not all of it good. I personally was the victim of an internet troll who took offence to this picture and this slide, which was used in part of the advertising for the webinar, accusing RSM of lacking a diversity and inclusivity policy, or at least they're lacking a very good one, by having 4 male, pale, stale presenters. I can assure you we take our diversity and inclusivity policy very seriously. The 4 presenters you have before you today just happen to be the experts in the chosen fields required for this presentation. Anyway, the agenda for today is, over the next hour or so, and we'll try and keep it to that, is to give you a taster for RSM. I guess there's no such thing as a free lunch, and this is our chance to share with the Causeway network and beyond what it is we're actually all about. RSM is a global multinational network of accounting firms with offices in over 120 countries now. If you're into league tables, we're the 6th largest in the world. We're large enough to matter, large enough to have offices throughout what I call the Causeway corridor. That line from Edinburgh, Glasgow, Belfast to Dublin perfectly aligns with the membership of Causeway. We are also small enough to have offices in places like Grangemouth, Lerwick, Birr and Portlaoise, places where the client base is not full of multinationals, but places where it's full of owner-managed businesses like you all present on the call today. And our core team deal with businesses of all shapes and sizes, but the owner-managed business is our key client focus. So in pulling the Planning for Brexit webinar together, we thought the most imminent thing that's going to impact people are the areas of VAT and customs. And Jim Burberry, based in our Edinburgh office, and indeed one of our UK partners on this matter, will try and tiptoe his way through the legislation, outlining the key issues for your business. I'm joined by my colleague, Paddy Stapleton, who is on lockdown in his native Tipperary, who will provide an Irish perspective on what Jim is talking about in terms of VAT and customs. Then joining us from South County Dublin is Warren, who I've asked to explain about the subtle differences between doing business in Ireland and the UK. We all might think it's pretty much the same, but there are subtleties in setting up limited companies in Ireland that are different from the UK, and I've asked Warren to talk to us about those. We will summarise at the end the key takeaways that I think you must do if you have not already done so as a result of watching this webinar. We will have question and answers at the end, but happy to take them through the chat box as we go through. And 2020 has been an incredible year for jargon such as lockdown and COVID and various other matters, but backstop is one that's really been associated with Brexit, and we hope to bring in our own backstop here at 1500, beg your pardon, 1700, 5 o'clock, to have you finished in time for your dinner or your favourite soap. So without, sorry if you can edit this out, we also plan on keeping this webinar interactive, and we have a number of polls throughout the webinar which Aoife will launch and will allow us to gain an insight into your preparedness for Brexit, and we can see how this aligns or otherwise with our own client base and make comments accordingly. So Aoife, if you could launch the first poll, effectively curious about what stage your business is at in preparing for Brexit, and then I'll hand you over to Jim Burberry to start the technical aspects of the presentation. Thank you.
Thanks, Patrick. Good afternoon, everyone. In this section of our presentation, I will run through the UK perspective of Brexit as regards the cross-border movement of goods and services, and then Paddy and Warren from RSM Dublin will give you the Irish perspective. So 65 days to the 1st of January 2021 and the end of the 11-month transition period following the UK's departure from the EU on the 31st of January this year. From the 1st of January next year, the UK will leave the EU single market and customs union, regardless of any late deal being struck between the UK and the EU. From then, the UK will operate a full external border with the EU. In turn, this means that there will be controls placed on the movement of goods between Great Britain and the EU. And as part of this, there are still several issues to be resolved as regards the trading goods between Great Britain and Northern Ireland. I'll come on to that matter shortly. For the foreseeable future, Brexit means both UK and EU businesses will have significant logistical, administrative costs and tax implications, which will require a holistic approach to achieve a commercially viable solution. The impact is not limited to the UK and EU trade, as the UK will implement its own global tariff for customs duties that will take effect on the 1st of January, and this will impact all goods imported into the UK from any other country. Moreover, a no-deal Brexit will raise the spectre of increased tariffs, quotas and more detailed outbound and inbound customs checks applied to goods moving to and from the UK and the EU, with the associated risk of the increase in delivery times and commercial costs. The BBC reported in late September this year that many businesses have still not considered the Brexit effect. Indeed, a survey carried out at that time by the British Chamber of Commerce found that only just over half of the businesses it surveyed had carried out a risk assessment ahead of the end of the Brexit transition period on the 1st of January, which does make me wonder when the other half will get round to it. I've got this mental picture of an ostrich with its head in the sand, with a Brexit sign above it, hoping for an 11th hour deal being struck. So let's take a look at the Brexit planning and avoiding pitfalls. Let's be prepared. Currently, the EU Single Market and Customs Union relies on frictionless border-free trade throughout the EU, so no import and export declarations. But the quid pro quo is that the requirement to complete other documentation such as EC sales lists and Intrastat declarations to provide trade information to the UK and EU tax authorities. With Brexit, an estimated extra 400 million customs declarations per annum is expected. The UK government recognises that this is a huge drain on resources for business, and even more reason why businesses should engage in the debate and take prompt action to manage their supply chains in association with their logistic managers, customs agents and freight forwarders. Imports into the UK will be subject to customs procedures, whatever agreement or none is reached between the UK and the EU, and clearly time is running out to make the necessary arrangements and have them ratified by government. Incoterms involving the movement of goods will become more important and clarity is vital. For instance, who is responsible for what? For instance, Incoterms delivery duty paid, or so-called DDP, into the UK means that the responsibility for delivering or dealing with customs declarations in the UK lies with the supplier and will likely involve UK VAT registration for that supplier, but minimises admin for the UK customer. I was on a call this afternoon with a client who is acting on behalf of Finnish and Hungarian suppliers of goods, and are directly having to look at their DDP terms with their clients, customers, and it's driving a risk of UK VAT registration and causing some concerns as to how they do that in their ERP or enterprise resource planning systems, and they use SAP to do that. But would other Incoterms for a non-UK supplier be more appropriate, such as say free on board, which would mean that the UK customer is the importer of the goods into the UK and thus no UK VAT registration is required for the supplier? Somewhat simpler. As part of a move to simplify UK VAT accounting for imported goods and import VAT, the UK will introduce on the 1st of January what we call postponed VAT accounting for import VAT. This is a very welcome change and will generate a cash flow benefit for the UK registered business by removing the need to pay and then reclaim import VAT, and instead import VAT will be declared and reclaimed as a book entry on your VAT return. Also, where title in the goods pass will be important. In VAT, it determines the place of supply of the goods, or if you prefer, the location of the goods where title transfers. This drives the VAT treatment. The VAT rules to determine the place of supply of goods, together with the interaction with Incoterms, is driving Brexit discussions amongst our clients, as I said, with their suppliers and customers. Another example is one of my clients who manufactures and supplies confectionery to retailers in Ireland, such as Tesco, Aldi and Lidl, is debating with those entities what happens post-Brexit and who will be the importer of such goods into Ireland, and in turn, if that requires this, in this case, the UK supplier of confectionery to register for Irish VAT for the first time. He's under some pressure to deliver goods on a DDP basis, which is a change in their current commercial circumstances. To further help businesses to prepare for Brexit, HMRC published a letter on the 14th of September this year that it sent to UK VAT registered businesses in Great Britain, not in the UK, trading with the EU and the rest of the world. In that letter, HMRC explained what those businesses need to do to prepare for new processes for moving goods between Great Britain and the EU from the 1st of January, such as make sure you have an EORI number, an Economic Operator Registration Identification number, As I mentioned, I'm currently working with a Finnish and Hungarian client to secure them a GB EORI number. They will need this to complete UK customs declarations for importing their own goods into the UK. Without this number, they cannot import the goods. However, if UK businesses will be importing their own goods into EU countries, they will need to have a separate EU EORI number. They can register in whichever EU country they wish for this and use this one EU EORI number for imports of their goods into those other EU countries. You need to decide how you're going to make customs declarations. Customs agents, freight forwarders and express operators can help you with declarations and ensure you're providing the necessary information. See if your imported goods are eligible for staged controls. Most traders with good compliance records will be able to defer import declarations in the UK for most goods for up to 6 months after the 1st of January. And decide how you account for import VAT when you make your customs declarations. As I mentioned earlier, from the 1st of January next year, businesses will be able to use a bespoke VAT accounting system for import VAT. And keep up to date. Check RSM's website and Causeway's website for our blogs and updates, and sign up on our websites for regular updates. There will be a new border between Great Britain and the EU. In July, the government issued its guide to how the border with the EU in the UK will work after the end of the Brexit transition period. This was updated again in early October, and I don't doubt further updates will follow. In essence, in the UK, there'll be 3 milestones between the 1st of January and the 1st of July next year. In summary, with effect from the 1st of January, we will have basic customs requirements implemented. You will then have 6 months to complete your customs declarations if they are required. And as I mentioned, we have the new UK global tariff will be in place. From the 1st of April, certain goods will require pre-notification before they're imported, and there will be physical checks which will continue at the point of destination in the UK until July 2021. And from July, businesses moving any goods, particularly into the UK, will have to make full customs declarations and pay relevant tariffs. Let's move on now to the Northern Irish Protocol. The basic premise of the Northern Ireland Protocol is the protection of the Belfast or the Good Friday Agreement and a single market on the island of Ireland. In its simplest form, as part of the withdrawal agreement, Northern Ireland will be part of the EU from the end of the transition period on the 1st of January, but its businesses will have unfettered access to UK markets. Importantly, the protocol applies only to goods. It's still subject to much debate in the UK-EU joint committees as to technicalities and practicalities. HMRC has now written to VAT-registered businesses in Northern Ireland highlighting actions they need to take to prepare for new processes for moving goods under the Northern Ireland Protocol from the 1st of January. There are 2 letters, one for Northern Irish businesses that trade with the European Union and the rest of the world, and another for those who do not, but who do move goods between Great Britain and Northern Ireland. The letters encourage both types of Northern Irish businesses to sign up for the free, often you hear VAT partners say the word free, trader support service, if it's part of the UK government solutions, if they move goods between Great Britain and Northern Ireland or bring goods into Northern Ireland from outside the UK. This free service went live on the 20th of September and will handle the new processes arising under the Northern Ireland Protocol from the 1st of January. Interestingly, the EU has just published its proposed legislation to implement a new XI prefix rather than a GB prefix for Northern Ireland businesses to use from the 1st of January on their VAT number on transactions in goods that remain subject to EU law, such as supplies and acquisition of goods between Northern Ireland and other member states. So let's look at the movement of goods under the protocol in a bit more detail. Put simply, the Northern Ireland Protocol means that the Northern Ireland maintains alignment with the EU VAT rules for goods, including on goods moving to, from and within Northern Ireland. However, Northern Ireland is and will remain part of the UK's VAT system. We've been poring over the practical aspects of this protocol and found that there is a lack of consistency between the intended implementation of the protocol by both the EU and the UK. For example, the EU's position is that goods moving between Great Britain and Northern Ireland are imports or exports, which would normally require customs declarations and would be zero-rated from a VAT point of view and subject to import VAT where delivered. Conversely, the UK's position is that Northern Ireland is part of the UK's VAT system, as I mentioned, which brings the expectation that goods moving between Great Britain and Northern Ireland are domestic UK sales for VAT purposes, if you like the status quo. This leaves the question on how goods moving between Great Britain and Northern Ireland will be accounted for in practice on the UK VAT return for those businesses. This needs to be agreed by the UK and EU Joint Committee and then clear guidance published by the UK Government and or HMRC so that those businesses can train their staff and update their finance systems before the 1st of January. We have some key questions that still remain to be answered. Will the movement of goods from Northern Ireland to Great Britain be treated as an export from Northern Ireland? What determines Northern Ireland goods with regard to import declarations being required in Great Britain? How will the movement of goods between Great Britain and Northern Ireland be shown on a UK VAT return? And what goods will be deemed at risk from moving into the EU from Northern Ireland? So when we rehearsed this presentation yesterday, I was asked by one of my colleagues what my best guess would be as to the answer to these questions. My answer was we'll have to wait and see, so no surprise there. As if by magic, and as Patrick mentioned, HMRC issued yesterday a policy paper entitled Accounting for VAT on Goods Moving Between Great Britain and Northern Ireland from the 1st of January. While not directly answering all the questions on this slide, this policy paper does address matters such as existing Northern Irish VAT registrations will remain extant. It looks like there'll be no new boxes on the UK VAT return to identify Northern Irish transactions. And sales of goods to third parties from Great Britain to Northern Ireland and vice versa will be subject to UK VAT if applicable. So that's interesting developments. The policy paper, however, does introduce further guidance, and though no further debate as regards the movement of goods, and thus no doubt further debate as regards the movement of goods such as stock between Great Britain and Northern Ireland and supplies of goods between members of the UK VAT group with or without premises in Northern Ireland or Great Britain. So we'll be examining this paper in greater detail over the next day or so. As I say, it only came out late last night, so keep an eye out on the Causeway website for our updates, and no doubt similar policy papers will follow in due course. It's worth noting in passing that the European Commission has launched infringement proceedings against the UK, which claims that its current internal market bill going through Parliament has breached the terms of the withdrawal agreement, which is relevant to the Northern Ireland Protocol. The UK has until the 1st of November next week to respond to this letter, so watch this space. So, Patrick said make sure there's some good news in this presentation, and here it comes. With regard to services, the VAT rules for the place of supply of services, which determines where VAT is accounted for and who accounts for it, will largely remain the same as they are now post-Brexit. So one thing for the service industry less to worry about. There's always some exceptions, unfortunately, so there are some use and enjoyment provisions if you're hiring goods that are used and enjoyed out with, in this case, the UK or the EU, and there's some benefits to financial services when supplied out with the UK post-Brexit. I just wanted to mention in passing the issue of fiscal representation post-Brexit, and I know Paddy will pick this up in his part of the presentation from his perspective as well. The current position in the UK is that businesses trading in other EU countries do not need to appoint a fiscal representative in those other EU countries to assist them in managing their in-territory VAT registrations. That said, an in-country fiscal representative is currently a requirement for non-EU businesses trading in some EU countries to represent the non-EU business for VAT purposes and generally becoming jointly liable for any VAT amounts owed by those businesses. However, post-Brexit from the 1st of January, many EU member states will require UK businesses with in-territory VAT registrations in those member states to use and engage a local fiscal representative, meaning those UK businesses will be required to engage a fiscal representative and change their type of VAT registration in those EU countries. And as I mentioned, this may be relevant to Ireland. That said, a fiscal representative is not a requirement currently for non-EU businesses trading in the UK, unless due to a perceived risk in their tax profile, HMRC insists one being appointed. So in summary, there are new VAT rules. Import VAT, we have the postponed accounting for import VAT, which is a blessing in terms of cash flow. There will be some increased VAT compliance as we see goods moving to and from, particularly in Great Britain and Northern Ireland and vice versa. There is on the horizon some other rule changes in July next year as regard e-commerce and B2C sales of goods. So if you're looking at fulfillment by Amazon and the like, things are changing there. As I said, we'll have a hard border in the UK, so we will lose the free movement of goods. We'll have full customs declarations required, and we may start on the 1st of January, depending on what deals are struck in the UK without a free trade agreement or on WTO terms. We'll have to wait and see. There will be in the UK a new customs infrastructure, which may result in tariffs. There'll certainly be increased border controls into Great Britain, and then there'll be checks potentially either physically or through technology between movement of goods between Great Britain and Northern Ireland. So in the short time available to me, there's a lot going on in and around the Brexit changes, and too much I'm afraid to cover in detail here. But I trust this has given you a timeous update of where we are at the moment. As I said, one place to keep up to date is to log on to Causeway's website or RSM's website and pick up our Brexit updates and blogs. And if you like, check out our solutions for helping clients with their Brexit readiness. So I think in summary, there's a great quote there from the Director of the British Chamber of Commerce trying to push government along and help us get to a solution. And as I said, the survey in September looks at about 51% of companies have still not taken any great steps with regard to prepare for the changes ahead of us. So there's work to be done, and you may be ahead of the game, still to catch up, but time is certainly running out. So if I can call for the next poll, please.
Very mixed results.
Okay, so some, I suppose, interesting but not surprising in terms of what we're seeing in practice. Thanks, Jim, for the UK perspectives. So I'm going to share some Irish perspectives. And I suppose before getting into the detail with Brexit, I suppose I'd just like to take a summary of Ireland as a place to do business. I suppose a significant amount of my time to date in 2020 has been spent dealing with UK companies of varying sizes, from mid-market companies to M&Es that require assistance related to the cessation of the transition period on December 31st. This means different things for different businesses, and a couple of minutes I will talk through some practical implications for UK and Irish businesses, you know, for arising from UK's exit from the single market. Before I do that, I'm just conscious from my interactions with UK businesses that the knowledge level of the Irish environment varies. So in that context, I've just listed below some of the key Irish features that make Ireland one of the most attractive places to do business. So, you know, Ireland is a long-term EU member, providing Irish businesses established here with access to the EU market and EU regulation. We operate a common law system, so our legal system, of course, was established and developed when Ireland was part of the UK, so UK businesses will find it very familiar. The basis of our tax code, for instance, was essentially modelled in UK statute, so the technical basis for key corporate reliefs and exemptions, while different, is very similar to the UK. Ireland, of course, is a Eurozone member, being one of current 19 members and one of the 11 initial founding members in 99. For any employer looking at Ireland, it's always a good factor to point out that Ireland has the youngest population in Europe, with 33% of the population under 25, and that is forecast to increase by almost 1 million to 5.75 million in 2040. So there is a very strong and competitive labour market here, with access to Europe's labour pool of 250 million people or so. Ireland, of course, has a very pro business environment, and competitive corporate tax policy is a key cornerstone of Ireland's offering. You know, the 12.5% rate gets a lot of publicity. It is one of the lowest rates in Europe, with the exception of Bulgaria and Hungary, and compares very favourably with the OECD average of around 25%. for UK businesses setting up here, whether Irish corporates are held personally or through a UK company, there is generally no withholding tax on dividends, interest and royalties. Importantly, there is also no Irish CGT for UK investors in Irish corporates, with the exception of investment in Irish real estate or real estate structures. To speak, I suppose, to the last point on the slide, it is also extremely straightforward to set up an Irish company. My colleague Warren will talk further about that in a few minutes, and it can be done with a minimal share capital of €1. So in that respect, it is worth highlighting that Ireland does not at this point in time have formal debt to equity ratio requirements, unlike other countries, for instance, Germany. These may be introduced from 1 January 2022. So what does this mean if you are setting up an Irish company? It means that you could fund it entirely with debt, which gives you good flexibility in that initial stage of the development of the business. So just moving to the next slide, you know, and to take a very quick look at the Irish budget. So this was announced just 2 weeks ago, and it announces the government's tax and spending plans for the year ahead. It was framed on the basis of a no-deal Brexit, assuming that bilateral trade between the EU and the UK will revert to WTO rules. And secondly, it is made on the basis that there will not be a widespread vaccine available. So in terms of Brexit, additional funding has been allocated for practical support across key government departments. Really,
sorry, Paddy, would you be able to move the slide along there?
Apologies.
Thanks.
So you should be seeing the fiscal
Perfect.
slide there.
Yeah, perfect. Yeah.
Okay. So yeah, as I said, it was framed on the basis of a no-deal Brexit and that a vaccine would not be available. So in terms of Brexit, additional funding has been allocated for practical support across key government departments. So really those are at the front line of Brexit, such as Revenue, the Department of Agriculture, and of course sea and airports for customs processes that will be at the forefront of dealing with, I suppose, the change requirements of dealing with the UK as a non-EU member. A 3.4 billion recovery fund was announced. The primary purpose of this is to stimulate the economy and mitigate against Brexit and COVID. The mechanics of this fund have yet to be announced. Ireland announced it will also seek to access the Brexit Adjustment Reserve. So this is a 5 billion fund announced by the European Council to offset the economic impact of Brexit. So Ireland will look to access this for sectors that need it most, for instance, food and agriculture. Again, the mechanics of that fund are not yet known, and the EU Commission are due to make legislative proposals for the new reserve in November. Ireland has announced it will also access the SURE scheme. So this is another EU loan system to support and mitigate unemployment risks caused by Brexit, caused by an emergency, so the COVID crisis. So to sum it up in terms of the budget, you know, huge public funding is being put in to offset the effects of COVID and a no-deal Brexit. And to put it in context, the budget was the biggest in the history of the state, with spending of over 17 billion and no tax increases, which is without precedent, and a complete contrast, for instance, to budgetary policy for the last fiscal crisis some 10 years ago, where austerity was pursued. So given the level of spending, it'd be difficult to be critical of the government in terms of how much more the state can intervene to assist the market. From a practical perspective, you know, while significant resources are being put into increased public administration required for Brexit and infrastructure at air and seaports, including technology and staffing, for now this capacity is really unproven. No one knows if this infrastructure will be capable of dealing with the huge demands that will be placed on it from the first week of January 2021. And I suppose what we hope doesn't happen is, you know, long queues of trucks at the ports, but really it's a wait and see on that piece. moving to, I suppose, the next piece of the presentation on the Brexit Omnibus Bill. So this was a key part of the government's preparation for Brexit. So this is a multifaceted bill that will amend and update existing statutes from the Taxes Acts, VAT law, Immigration Acts and Employment law, all geared to mitigating insofar as possible disruption to the economy from Brexit and dealing with the UK as a non-EU member.
Sorry, the slide's not moved again, sorry.
Sorry,
that's perfect, thanks.
Okay, so it is worth mentioning that Ireland and the UK operate a common travel area. So this predates both countries' EU membership, regardless of what type of deal or not is agreed. Irish and British citizens may move freely and reside in each other's jurisdiction and enjoy certain rights, including the right to work without a visa. So this is a very practical example of how the Omnibus Bill is required to amend existing legislative provisions to preserve those rights. From a VAT perspective, the key piece in the Omnibus Bill is the proposed introduction of a postponed accounting system for VAT, which Jim also mentioned earlier. So this will be relevant to Irish and UK businesses that require Irish VAT registration from 1 January 2021 or hold an existing registration and where you import goods here. So at present, the importer of record must pay importation VAT to clear customs. Under this new system, importation VAT is not required to be paid at customs. Rather, you self-account for it in your VAT-3 return. So really, this is a cash flow relief, bearing in mind that many Irish businesses, particularly in the SME sector, will not have had to pay importation VAT before. So you could say this measure takes the sting out of trading with the UK as a non-EU member, essentially leaving customs duty as the real cost of importation. Following the budget, we had the Irish Finance Bill published last Thursday. So a key change to flag to UK businesses is that revenue will be given the power, as proposed under this bill, where they believe it necessary to require a non-established business to appoint a tax representative. So this tax representative must be located in Ireland or another EU jurisdiction. So this is essentially similar to the fiscal representative requirement that some EU jurisdictions currently operate that Jim mentioned earlier. The representative will be jointly and severally liable for the importation VAT due by the non-established trader. The draft legislation is such that revenue will have discretion in terms of selecting what traders they will impose this requirement on. We expect revenue to publish something on this hopefully in the coming weeks, because businesses will need time to appoint representatives if they require one and understand their requirements. And equally, I suppose, from a practical perspective, service providers in the Irish market will need to gear up to provide a service which is new, particularly considering the representative will have joint and several liability, which of course will require them to cover off practical matters such as their insurance cover. So I suppose really moving on there to the next slide on goods. So, if you are a UK business that is importing goods to Ireland, or if you are an Irish business that will trade with the UK and take goods into Ireland from the UK. So these are just some practical points to cover off. Firstly, for UK companies acting as the importer of record in Ireland, you will need an Irish VAT registration. Firstly, you will need to self-account for importation VAT, as mentioned earlier. Secondly, there will be a requirement to charge Irish VAT on the onward supply of goods to your customer, because of course there is a nil registration here for non-established traders. So if you are a UK business supplying goods to the Irish market, if you have not already done so, you need to engage with your Irish customers to agree who will act as the importer of record, because that determines who accounts for VAT. Our experience here, I suppose, varies in practice. For example, I've seen UK businesses supplying large national retailers that have been told they must act as the importer of record, which accordingly means they bear the potential customs cost. I've also seen UK businesses that have many Irish accounts of varying sizes, and I've seen UK businesses deciding to front up and communicate to their customers that they will act as the importer of record and deal with the VAT and customs requirements. I suppose obviously driven by commercial policy to remove customs and VAT administration and the related costs as a threat to their market share. So they're effectively saying to their customers, we will deal with this burden. In terms of registering for Irish VAT, it's quite simple. Businesses will need to complete a form, what's called a TR2FT, assign it and email a PDF copy to the Irish tax authorities. So completing the registration is quite simple. In terms of the length of time to register, in an ordinary time, it takes approximately 3 to 4 weeks. I suppose given the COVID crisis and the, I suppose, large volume of registrations for Brexit, this in some cases can be up to 6 to 8 weeks. So just be careful of that timeline and give yourself enough time to register. So once registered, you will need an EORI number if you don't already have one. So this is issued on the day you apply for it. So that's really easy to cover off. Your appointed tax agent can do this for you. Another practical matter for UK businesses is that you will need what's called a revenue online system certificate. So you will need to apply for this to the Irish tax authorities once you get your VAT number, and that takes about 3 to 4 days. The reason you need that is to pay and file your tax returns, your VAT returns, and to engage in correspondence with revenue. I suppose looking to Irish businesses importing goods from the UK, you will need to obtain an EORI number in order to clear customs. So you may not have had that requirement before, because obviously it's currently an intra-EU acquisition. Post 1 January 2021, it won't. If you are an Irish company supplying product to the UK, currently these are intra-community supplies on which no VAT is due. From 1 January 2020, these will be exports as they will be leaving the customs territory. So in principle, there is no change in the economic treatment, but you will need to look at your ERP and accounting software for your UK accounts to code those sales as exports. And I suppose the real practical implications of that are you will no longer be required to report those sales on your intra-stat returns, and also those statistical boxes on your VAT return, the E1 and E2. You will no longer need to report sales and acquisitions to the UK market on that part of your VAT return. So it's just a matter of looking at those practical matters. I suppose finally, looking at the Northern Ireland Protocol, for Irish companies trading with Northern Ireland businesses, under the protocol for VAT purposes, they will be deemed to be intra-community supplies and acquisitions. So really, I suppose, in practice, nothing changes there. Moving to the next slide for services. So for Irish businesses, there isn't really a fundamental shift here. You know, the supply of Irish businesses is currently an intra-community supply of a service. From 1 January 2021, this will simply be outside the scope of VAT. The usual exceptions, of course, apply, you know, a movable property being the most common. You know, previously your supply of services to business customers in the UK currently would be reported as an intra-community supply. Again, you'll need to look at your ERP and accounting systems in order to code these properly. You won't be required to report these on your EC sales list. And again, your statistical reporting in the VAT return, you will no longer need to report those supplies or acquisitions with EU businesses after 1 January 2021. So I suppose really the change in services is quite minimal. You just need to look at those practical pieces on your accounting software and ERP systems. I suppose moving to, I suppose, some other tax factors and non-tax factors, in terms of, you know, UK businesses looking to Ireland and what type of structure to establish, you know, is it a fixed establishment, an Irish branch or a limited company? I suppose firstly, if you only require a VAT registration and you have no presence in the state, you don't need a structure, you only need a VAT registration, and you shouldn't need any other registrations. If you intend to have people and functions here, you will need to consider whether you operate through a branch or a limited company. The starting point, of course, is to consider if sending people here triggers an Irish permanent establishment, so a taxable nexus on which Irish corporate tax is payable on part of your profit. This would be driven by, you know, what your employees or agents are doing here, and whether you have a place of business in the state or not, and other factors. And one thing to flag, if you have employees at your customer's premises in Ireland, that can be deemed a place of business by the Irish tax authorities. In terms of, you know, branch versus subsidiary, from an Irish perspective, both options yield a very similar result, as the profit allocation to the branch should be very similar, as it's taxed as a standalone establishment. And of course, both are taxable at 12.5%. So really, Irish tax matters shouldn't be the key driver. The decision should be driven by, I suppose, commercial and potentially regulatory matters if relevant. The usual benefits, perhaps, of segregating certain business with particular markets under a separate limited company. Obviously, with a new limited company, you need to bear in mind this will introduce more cost and compliance in your group than a branch will. I would flag that it's also important to discuss this decision with the input of your UK tax advisor, particularly if you're moving part of your UK business or assets to Ireland. Equally, of course, Irish businesses sending employees to the UK will also need to go through that process to consider their requirements in the UK. Just to flag then on the 12.5% rate, it is very important to flag for UK businesses that rate is not automatic. It requires that substance in the form of real business operations and functions is established in Ireland, because otherwise, you know, the higher rate of corporate tax may apply, which is 25%. So that needs to be thought through carefully. Management and control. So UK tax law has a concept of central management and control. So that level of control needs to be carefully exercised. What you don't want happening is setting up an Irish company and having its central management and control exercised from the UK, because otherwise that may run the risk of triggering UK tax residents of your Irish company or a UK branch of your Irish company. Transfer pricing, I suppose you just need to bear in mind that if you do set up a company here, all transactions will need to be priced at arm's length terms to ensure that you have, you know, the appropriate level of profit booked in the UK and Ireland in respect of related party transactions. You may have documentation requirements here, but there are RSM exemption criteria, at least at the moment. In terms of people, if you are sending people to Ireland, or if you're an Irish business sending people to the UK, you may have payroll tax implications to consider and HR issues, but there are exclusions for payroll tax registrations at both sides of the water for short-term assignees. It is worth then just very briefly mentioning SARP, which it's called a Special Assignee Relief Programme. So if you're a UK business sending a senior employee to Ireland, it is very important to look to see if that employee may qualify. It applies to employees assigned here on a salary in excess of 75,000 and operates to exclude 30% of their employment income from the charged income tax up to a limit of 1 million. So it's very substantial relief, and note that there is a 90-day time limit to apply for it from the date of arrival. Then I suppose, you know, if you're a UK business, do you need an Irish or an EU bank account? There certainly isn't a tax or legal requirement to have one, but if you need one for your trade with Irish or EU customers, you know, you just need to take into account it takes time to set that up. It can vary from 2 weeks up to a number of months. And then I suppose finally your requirements, your compliance requirements, I suppose you need to just bear in mind that it will take time to appoint, you know, tax agents, customs agents, etc. And with 65 days to go between all of those other matters I mentioned, the sooner you can do that, the better. So that pretty much wraps up my piece, and I think we're going to take another question before we go to Warren.
Okay, thanks very much, Paddy. I'm sharing my screen here, and Aoife, can you run the final poll, please? We're running the final poll. And I just want to confirm, everybody, this is a once-in-a-generation vote, so please choose wisely because we won't be rerunning it. So I'm just going to let everybody vote there. Just a little bit of background while I'm waiting. I have been with RSM in Dublin here for 11 years this week. I work in management consultancy, specializing in outsourcing, and basically what I've been doing my whole career is helping companies from all over the world set up in Ireland. So interesting poll result here. We can see certainly there is a lot of people with businesses in both sides of the jurisdictions. So obviously Brexit is going to have a huge effect on these people. So we're under a little bit of time pressure now, so I'm going to crack on into the presentation. Basically what I'm going to do is I'm just going to run through very quickly company structure or in Ireland. In a nutshell, it's very similar to the UK, but there are differences, and those differences are the things that can trip you up. And also then I just want to highlight timelines. While the process might be straightforward, there are timelines involved, and we are facing a fixed date at 31 December 20 for Brexit. There appears to be no chance that there's going to be any extension of that period, so timing is important. So the good news is an incorporated company in Ireland, very straightforward. A lot of the terms similar to the UK. Basically we copied the UK legislation, but there are some differences. One of the main differences would be we still have the concept of a company secretary. I understand in the UK now it's possible to have a company with just a single director and not a company secretary. In the UK you have a company's house, we have the company registration office, which effectively carries out the same functions. So there's let's say there's two main branches. One is an incorporated entity. The other would be a branch, which is the establishment of an external company or branch. So for a branch, there's a couple of things that are required. One, you've got to provide notarized and apostilled copies of your UK company's memo and arts. So again, with COVID, that could be delayed. I don't know how that process is in the UK, but in Ireland at present we're in level 5 lockdown, which means a lot of offices are not physically open. So it's just something to bear in mind if you're looking at establishing a branch. To establish a branch, you have to have a registered business address in the Republic of Ireland, and you have to have a registered person who is available to act on behalf of the foreign company who is resident in the Republic of Ireland. So that's the two main criteria. Once the branch is established, you then essentially file your UK accounts, and you also update the CRO, the Irish Companies House, with any changes in your UK company. Then we have, in Ireland again, we have various types of companies. I don't propose to go through them all. The main company, which is about 95% of companies in Ireland, is an LTD, a limited company, very similar in concept to a limited company in the UK. We also have a DAC, designated activity company. Typically it's used if there's an SPV or in a financial service where it's required by regulatory requirements to have a DAC. So as I say, 95% of the companies are LTD, so that's the one that we're going to focus on today. So the main features of an LTD in Ireland, you can see them all. I won't read them all out. One important thing is there is a requirement, well, sorry, let's just take it back. You can have a single director in an LTD company, but there is a requirement to have a director resident in the EEA. So on the 31st of December, the UK is no longer be in the EEA, the European Economic Area. Now, if you don't have a resident director, it's possible to put an insurance bond in place for a 2-year period. Typical cost of that is about €2,000 for the 2 years. Once the company is incorporated, and if there's substance here in Ireland and trading, it's possible then to get what's called to demonstrate a real economic link, and then the bond may not be required in future. As I say, unlike the UK, there is a requirement to have a separate company secretary if there's only a single director. If there's 2 directors, one can act also as the company secretary. The company secretary can also be a body corporate, another company as well. That's an option as well. So again, we don't have the concept of memos and arts was changed in 2014. So we now have a single document constitution. which covers all the rulings of that particular company. Again, something that often trips people up when they're coming in is the CRO are very strict on the names that they will allow for companies. So I'll give you a very brief example. I have a client who we're in the process of doing incorporation for. It's a global brand. They want to have that brand name reflected in the company, but one of their sister companies already has that name in Ireland. And to do so, then we've got to get approval from that other company to allow us to use that name. So, you know, I've had a number of clients coming from the UK who are looking for specific names, and that's not been possible. We've had to come up with a different name for the company. Again, what we recommend is we check the name in advance, and we can reserve that name for any particular company that you require. Company address, again, a limited company, much like a branch, also has a registered office in the Republic of Ireland. The registered office, it can't just be a PO box, it has to be somewhere where documents can be delivered and persons can also call into. Again, a lot of service providers like RSM will provide that sort of a facility. So again, as I mentioned previously, this is around the importance of having a director in the EA, and if not, being prepared to put the insurance bond in place. So once the company is incorporated, what are the requirements? Again, a lot of this very similar to the UK. So you're going to have to file your annual return. Your first annual return is filed 6 months after date of incorporation. No financial statements are filed with that annual return. The next annual return is filed 12 months after that. That's when you file your first set of financial statements. Again, like Companies House, all this information is publicly available. Typically, you file what's called an abridged set of financial statements. Again, there's a requirement to have an annual AGM, annual general meeting, once a year. For the financial statements, you're going to file either unaudited or audited financial statements. Basically, it depends if the company meets the audit exemption criteria. I won't propose to go into these in detail today, but there's a number of different criteria. One thing to note, if the company is part of a group, the criteria is judged on the group as a whole. And again, you know, that may mean, you know, you're taking in your UK companies as well, and it may trigger the requirement to have an audit in Ireland for your Irish company. So again, this is just kind of a little summary which shows you the requirements that you have for whatever entity you end up in Ireland. So obviously a fixed establishment has the least amount of regulatory requirements. Essentially, you may just have a VAT number, and if you have employees in the Republic of Ireland, it may trigger a PAYE payroll tax. Then if you have the branch of the corporate of the UK corporate, you have to file your annual return, you file your UK company financial statements, your corporation tax return in Ireland, your VAT, and your payroll taxes as required. And then for a limited company in Ireland, it's similar to what you have in the UK. You've got to do your full filing. One little point to note as well, which has come up for a couple of UK clients, is in the Republic of Ireland, for your directors, it's required to disclose their residential address. So in the UK, directors often disclose a business address. In Ireland, you're required to disclose the director's home residential address unless you receive a letter from the Garda Síochána, which is the Irish police force, of senior level, saying there's a security risk in doing so. That is not easy to obtain, so you know you are required to declare the director's home address, which some people are not comfortable with.
Hi, just to jump in there, I'm aware it's 5 o'clock. We're running a bit behind, but we're happy to stay on 10-15 minutes late to get some of these questions answered, and we'll save the chat and we'll address any questions in the chat privately later after this event as well. Okay.
That's fine. I'll just wrap it up here now. So basically what we're trying to do here is we're just trying to give you a sense of a timeline involved. So at the moment, so first things first, you review your structures. Do you need to have, what sort of entity, if any, do you require to have in Ireland? So typically at the moment, the CRO is running between 5 and 10 working days delay in incorporating companies. So that's when the original documentation, that's from when the original documentation is submitted to the CRO. So there is that sort of a backlog at present. And that's due to COVID, and it's also due to the volume of companies that are being incorporated due to Brexit. So a lot of UK companies have been incorporating companies in Ireland, and a lot of companies previously that would have gone to the UK to access the European Union market are now coming to Ireland. So that has created a backlog. So that is one thing to be aware of. Now, what the likes of ourselves, RSM, and other service providers are doing is we have shelf companies that we've incorporated previously. So we have these available for clients to try and speed up this process, but it is something just to be aware of. You can't then commence your tax registrations until the company is incorporated. So again, that's a delay, and that's why having a shelf company speeds up that process. If you don't have your VAT number, it's going to be very difficult to trade. So that's why, you know, Paddy was focusing on, it can take 6 to 8 weeks to get a VAT number, but until you have a company or an entity established, you can't start that application process. And then ready to trade, as Paddy mentioned, opening an Irish bank account, you're going to suffer all the same anti-money laundering requirements that you have in the UK, except probably more stringent. So again, what I typically recommend to clients is, if you have you speak to your customer relationship of your bank in the UK, see if they have a corresponding bank or relationship with a bank in Ireland, and look for a warm introduction through that. So apologies for speaking so fast, just trying and catch up on the time here. Patrick, do you want to say a few words?
Yeah, thanks, Warren. I was actually going to say that Theresa May promised us all a backstop in the same way that I did, and then let us all down. So apologies, folks, for running slightly over. What I wanted to leave you all with was 5 key things that you must do if you have not already done so. Pleased to see that our poll at the beginning of the event had most people well on the route to looking at what they need to do for Brexit. Supply chain contract terms need to be reviewed and discussed. Free on board, duty paid means so much different now and means a lot more money. The relevant legislation, we have skimmed through it. Trust me when I say the 3 core presenters can talk about this for a lot longer. There is a lot of information there. You need to speak to somebody who is understanding that information. You've got to quantify your exposures to all of this. You might not be too exposed at all. I've got one client over here who installs bathrooms for self-employed. Basically, the cost of his raw materials has gone up. He's put up his prices. That's his exposure. You need to engage with your customers and your suppliers. You need to be talking with them to figure out where things go from here. And finally, identify whatever registrations are required. There was a time, beginning of this year, when I was getting 1 or 2 inquiries a month regarding setting up or incorporating in Ireland. We very quickly came to 1 or 2 inquiries a week, probably over the summer. And today I've had 3 inquiries. One of those is so live, Warren, I'm about to ask it to you in our questions. But to summarize, folks, you'll all have your advisors. If they're as well versed on it as we are, please engage with them and ask them how they can help. The one plug for RSM here is as I've explained, we've got offices throughout the Causeway corridor. We have offices throughout England and Europe. We have dedicated experts on the subject. And if you want to contact us, any of us, privately or separately, our emails will be on this presentation, which will be emailed out to you all. And the 2 web addresses on the screen right now are where you can keep up to date with what we have being pushed out. Finally, just to thank all the presenters. It was very difficult pulling people together from 4 or 5 locations, putting the screens together. And I know you guys put a lot of work into it, and thank you. Thank you to Aoife and Causeway. Aoife, have we time to take a few questions, or would you prefer we wrapped up?
I think we can answer a few questions. Yeah, I think it's been quite lively on the chat, and we've said we'll answer 1 or 2, but I'll collate all the questions from the chat and get answers tomorrow and then circulate it to all attendees. So if anyone wants to shoot off.
Thank you. Well, just picking up a couple of questions that I think tease out what are quite relevant. I've had a question in here from an Irish SME, and they want to set up a UK company to deal with all their UK trade. And they want to know, should that be a standalone company or a subsidiary company? And that's a question we get asked all the time. I asked Paddy last week, so I know, Paddy, you will have an answer.
Yes, Pat. I suppose probably need to understand a little bit more about the facts and circumstances of the business, but generally it's better to set it up as part of their corporate group. particularly if there's an eye on a future sale down the road, to avail of what's called a participation exemption. So it can, you know, give better options to the shareholders in terms of their, you know, their use of the cash from sale proceeds if they ever sell down the line, but also simply for practical reasons like funding the company. You know, after setup, it would be easier to do that if it's part of their existing structure rather than holding it personally.
Okay, so it depends, but that's kind of the default answer.
It depends, but generally, part of the corporate structure.
A second question that has literally come into my from one of my clients throughout this, and I can share this with you if you want to see the timeline. It's not a setup, honest. We would like you to set up that company in Ireland for us as discussed. Warren, you explained that in Ireland we can use our address as the company's registered office address, but they've asked us if we can be their corporate company secretary, and I don't think we can we?
No, we don't typically act as the corporate company secretary, as we're also an audit firm and there may be a conflict there at some stage. But what we do have is we have a panel of other professionals who can provide that service, and we typically connect them with our clients, and then they will act as the company corporate secretary.
Excellent, thank you. Jim, most of the questions in the chat relate around UK VAT. Is there any of them you feel happy to answer straight off, or would you like to get back to these people individually?
No, I'll mention thanks, Patrick. I'll pick up a couple of them in headline terms, and then I'll give some detail tomorrow, if that's okay. There's a question about, you know, I have a Northern Irish company with an Irish branch, and we move goods back and forward between us. What will be the import VAT issues post-Brexit? I summarise the question on that basis. In headline terms, whatever the treatment is now, i.e. when the UK and in this case Northern Ireland is part of the EU, will be the same post-Brexit. The whole point of the Northern Irish Protocol and the arrangements that have been put in place is that there is a frictionless border in the island of Ireland, and it's as if Northern Ireland is part of the EU for the purposes of the Brexit negotiations and so on. So you should be able to comfortably move goods back and forward across the border on a VAT-free basis. Not imports, not exports. It's just the arrivals and dispatches that you used to do now. So nothing really changes in terms of your tax exposure. There's a slightly different way of perhaps recording that transaction, but I'll explain that in more detail tomorrow. But the headline being, because it's in Northern Ireland and because of the protocol, then it is a VAT-free, frictionless environment post-Brexit. So business as usual to some extent. The other question was a UK company being pressurised by its EU customers to be, in essence, to import the goods rather than the customer, so that the customer doesn't get any hassle from acting as the importer of record and so on. And as Patrick mentioned, I've had one question like this maybe 2 or 3 times in a quarter. I'm getting this 2 or 3 times a day just now. So the real headline issue is, who has the commercial power here to demand that either the supplier from the UK to the European customer, or the European customer can determine how the goods will be delivered and who should pay any customs duty and freight costs and so on and so forth. What it is driving out, and there's no disrespect to Ireland, there's an awful lot of stock holding in the Netherlands at the moment. The Dutch seem to be very good at distribution networks. It's quite a good network in terms of road and rail and air and moving goods around the EU. So part of the debate is, why is the customer demanding that you, the supplier, act and pay all duties at importation into whatever EU country it is? Because that will have an impact to your profitability and your cash flow. If you can't get beyond that, then chances are it'll expose you to either a new in-country registration, and you'll import from the UK into that country and then make supplies in the EU from that. So the fact that the customer seems to have the buying power may actually drive out the need for you to maintain a stock holding in Europe rather than the UK, and fulfill customer orders from that stock holding. and therefore you need a third-party warehouse provider and so on and so forth. But I would urge you to identify why the customer is demanding that this change is in place commercially, and then from that point of view we can work out the VAT solution. But it could be a new VAT registration in country, it could require you to be in a stock holding in country and fulfil orders from that stock holding. And as we mentioned, because of inter registrations required, it may also require fiscal representation as well. So a lot of hidden costs come with that demand from the customer. I'll explain more tomorrow.
Excellent. Thank you very much, Jim. Aoife, we're happy to leave it there if the members are. I know you have you've one final thing to sign off from Causeway. Thank you all very much for bearing with us. Delighted to speak to anyone and pick up offline. Our details will be circulated, and we promise get back to those with the questions that have been raised already. Thank you all very much.
Yeah, just to reiterate, thanks very much to everyone for coming along today, and thanks very much to Patrick, Paddy, Jim and Warren for that really informative talk. I feel like we could have had 2 hours on that session. It was just kicking off in the questions, but we will follow up with everyone who has asked a question, and we will get back to you tomorrow with some answers to those questions. I'll circulate it to the RSM team, and we'll get back to you with the slides as well. Just very, very quickly, because I know people want to get away, you're very welcome to come along to some more forthcoming Causeway events. We have an event in mid-November on exporting and trading across the Irish Sea. This is going to be hosted by one of our Causeway board members, Martin McBride. He's a Donegal man with a business in Belfast, and he works with clients across Scotland and Ireland. So that should be a really informative event for businesses who are considering or curious to learn more about trading across the Irish Sea. Also building on from our successful Growing Our Cities event that we had held last May, we're having a follow-up event with Jacobs and the Edinburgh Centre for Climate Innovation. That's going to be at the end of November, the countdown to COP26. We're also in the progress of developing a Digitising the Construction Sector event in early December. And also we're having a pre-Christmas, just pure networking event on the 10th of December. So I'd really encourage, if you want to know more about the Causeway Network, if you're not already a member, please come along, and we'd love to see you there to network with you. Just a quick bit about membership. If you want to join our membership, it's really easy. You can sign up on our website. RSM are corporate members of ours. Corporate membership starts from, corporate membership starts from £315. We're really keen to grow our membership as much as we can, just to help the network grow and flourish, especially during these challenging times. So yeah, we'll follow up tomorrow. We'll be in touch with you. We'll drop you an email. We'll share the slides. We'll get back to the questions. And I'll just like to close by thanking today's speakers for a really informative session, and we'll hopefully see you soon at another Causeway event. Thanks very much, everyone.